John, you have no audio. Can you try again?
Do you hear me now?
John, no.
No audio.
I think mine is okay, right?
Yes.
Okay, I hear you, Nadia. It's okay.
Can't hear Sean though. Oh,
No.
okay.
Oh, he's taking his coffee, I think, Sean.
Can you hear us? We cannot hear you. Maybe you can try to re-log in, see if that works again.
But I think it's okay.
I can't hear him.
Why is nobody hearing me? Is my audio?
Oh, now we hear
Yes,
you.
we can hear
I
you.
hear you now.
Yeah.
5, 4, 3, 2, 1. You can hear me. You can see me. My headphones are not
Yes,
working.
yes, yes, all good.
For some reason. Okay, well, let's kick off then. It is the Daily Energy Markets podcast. It is no longer 10:30 a.m. UAE time. It is 10:33. And Brent crude oil, despite it not being 10:30 anymore, is up or down rather, down nearly 1% at 68.51. But some upward motion in the oil price yesterday as we moved deeper into the week, closer to the OPEC agreement and also closer to the sort of explosion of all of these tariff trade deals or the absence of them. And of course, the third sort of big thing bouncing around the news at the moment is, I hate to keep saying it over and over again, I'm not even sure if it's the official name, but what is called the big beautiful bill. I refer to it as the budget, the US budget bill. And nonetheless, that is in its sort of hot red lights flashing moment of being passed. And of course, it's full of 1,000 pages of stuff that it's even hard to get your head around to the extent as to what is actually in it. It does seem one thing of note of relevance that we hear about is that it is contains elements of killing off all of the Inflation Reduction Act incentives for the renewable sector, amongst many other things. I haven't read the 1,000 pages, to be honest, but I know Nadia Martin Wigan, director of Sveland Capital up in Norway, where they've lots of free time and incredibly long days to read such things, that she might give us some of her thoughts as to whether this is of relevance to the oil markets. Do you think this bill, which is ginormous, apparently going to put $3 trillion on the US debt, get out of dollars as quick as you can? And is it bullish, bearish, or neutral, irrelevant for oil markets? Your thoughts?
First thing is, if and when it passes, that's just supportive for markets in general because we actually know something. The bill is not popular. It's been cited as the least popular legislation since the 1990s. But if it passes, it means that there are some things that some will like and many things that many will dislike. On the oil side, well, the number one thing is the fact that the oil price and the gasoline pump price is down year over year, more than 7%. So that's the number one driver near term. But I think if people have more consistency in beliefs and understanding and companies, this bill will help. On the other hand, we'll talk about the trade deals afterwards, which is the uncertainty. I think ultimately, though, the bill is inflationary, and inflation is supportive of oil and commodities in general. And finally, down to the renewables part, well, everyone knew when Trump was running for election, he hated wind. Maybe he liked solar, maybe he didn't like it. He's not a big fan of EVs or Elon Musk these days on the latter point. So I think the market initially had a big knee-jerk reaction when he got elected and said all of this renewable subsidies, IRAs, environmental protection is all out. So how much more downside needs to be priced in? Well, that I'm less certain of.
Let's welcome Shoaib Boutamin, Energy Advisor and CEO at Ranadrill Consulting, sitting in Algeria. Shoaib, another big event coming up in the coming days, of course, is the OPEC Plus meeting, the decision on the next steps with the unraveling of the 2.2 million barrels a day cut. What is your expectation from the point of view of the decisions that will be made here? We saw some momentum upward in the oil price yesterday, seemingly that this announcement coming this weekend is impacting upward motion on the oil price at the moment. Your thoughts on that decision and what it's likely to be?
Yeah, good morning. This is a really great question. I think what's really happened, all the reports we see now, we review now at the OPEC Plus, the OPEC is going to wind more 411,000 barrels by August. But from my opinion, I think it should wait and see, because the OPEC just resuming just a couple of days, resuming pumping more than 411,000 barrels of oil. So we'll have now like 1.37 million barrels of oil per day as an in wind. So adding more than 400 in August, I think is really very tough, because if we see the stockpiling in China at the moment is at a record level, and we see a report that is like 1.18 billion barrels are really stored in China now. And we see what happened the last week in the United States. Inventories increased by 3.8 million barrels. And this is what was not really expected at all. So I think the right thing, in my opinion, is just to wait. So we are adding more than 400,000 at the moment and 11. So I think should wait and see. Because if we see the fundamentals at the moment, yes, we feel like we're very happy. We are in the summer season. We know demand is very bullish. Everything is okay, but we have to think about the fourth quarter. We have to think about August, September, October, when demand will come back to the previous levels, and I think we'll face many challenges. And this is the question. Maybe OPEC Plus will be ready to cut again if prices drop to less than $60? I think this is a big question, because we have to remind everybody that the 9th of July, it's like in 6 days from now, U.S. administration will have a look on the tariffs imposed on the famous day, Liberation Day, the 2nd of April. So I think this will really impact the global oil market. And we know that negotiations are ongoing with China, with India, with the European Union, and with Vietnam. I think yesterday they said they have agreed to reach to impose only 20% of tariffs and between on Vietnam. But I think you see only one country is impacted, has an impact on the oil global market. So imagine something will happen the 9th of July. I don't know if no positive things will happen in negotiations, I think will impact a lot the global oil market. That's why
we've certainly got a lot to do in a few days. I mean, it's been 90 days, but it seems there's been only very few actual trade agreements. The most recent one seems to be Vietnam, which could be quite a significant one because, of course, it is the back door for Chinese goods to make its way to the US market now, and the politics around that could be interesting. Let's go to London with Ahmed Mehdi, Managing Director at Renaissance Energy Advisors and Senior Fellow at the Oxford Institute for Energy Studies. Ahmed, also what's happening on July 9th is OPEC, the OPEC International Seminar in Vienna, of course. It'll be the first time that a lot of the members of OPEC and OPEC Plus will be seeing each other face to face since all of this drama started with the accelerated increases. And in the heart of that, of course, is Iraq as one of the naughty boys in the class, so to speak. At least that's what the reporting is, overproducing its quotas for some time. So I'm not sure if there's going to be some good fisticuffs in the corridors there or not. But your thoughts on OPEC Plus raising quotas again? Can any country actually raise production?
So I think if you just take it in the context of where OPEC Plus sits as to the drivers behind the acceleration of the unwinding, I think that I don't necessarily agree that it's the market as it is today is anathema to them doing the unwinding. There's refining margins are pretty robust. Refined product stocks are still relatively low. You're seeing diesel outperform at the moment. The forward curve is showing the backwardation. So everything is pointing to, if you're going to do this, this is the time to do this, in terms of the unwinding, which they've been, sitting on that, the group of 8 has been sitting on that now for quite a while. Yeah, you're absolutely right. And, you've kind of answered your own question there because, you're right in the sense that the actual amount of physical crude that will come into the market may not be equivalent to the 411 KBD that was alluded to earlier. So I see this more
like it's been the case up till now that. Well,
yeah, but I think I was just going to say that if you look at the seasonal, Chirag mentioned the seasonal demand patterns. So how much will actually be exiting the market? I think I see this more as a mark-to-market exercise. You're marking the physical production of these countries with the paper volumes that's in the supply roadmap. And Iraq is obviously one of those countries. Kazakhstan. I don't think this is about price wars or market share wars. This is really about Saudi trying to recalibrate its position within the OPEC group. So the key word is within. Okay, this is not about shale or anything like that. This is about OPEC plus internal and internal. I would call it mark-to-market exercising.
Is that a good thing or a bad thing? Is that a friendly thing or an unfriendly thing? Will there be?
I think it's been said earlier. They're doing it because they can. The crude inventory is where they are. The product stockpiles where they are. Diesel margins are very strong. The market's still backwardated. And actually, most of those countries you've mentioned, Kazakhstan, Iraq, etc., are already producing above their quotas. So in a way, the actual volumes that that will increase will be from Saudi. So I think at the moment, as I said, the forward curve at the moment, as Chirag mentioned, is showing that they can. This is the right time to do it, but later there will be issues. But we don't know where the macro direction of the market is based upon the uncertainties that you've mentioned with tariffs, and we still don't know what the inflationary effects are going to be. So we'll wait and see.
Nadia, is this a sort of your talks of one of the big headlines of the year? Obviously Trump's return to power is nothing bigger than that, but ultimately, is there a second headline that says, well, actually, global economic growth, or at least oil demand, is better than was kind of the bearish tone has indicated? China is not gone off a cliff. And as Ahmed mentioned, there are some fairly positive, bullish tones, which sets up for a more sort of supportive oil market in the second half. A lot of the narrative pre-Iran-Israel conflict was that the second half would see a big surplus with these continued OPEC plus increases, and with that, a very strong downward pressure on the price. Is that narrative now no longer valid? Your thoughts on more robust demand than was sort of anticipated in 25?
Well, absolutely. When you look at the end of 2024 as well, I mean, there was expected to be huge builds that we did not see. And that's when the market really started selling off, was last summer at this point. And we've been in this kind of bearish trend that finally got stopped about, call it a month ago, 2 months ago, in May, that we finally, stopped this kind of drift. If you take aside the cold weather we had in January in the Northern Hemisphere. And I think that that's where demand really outperformed, was Q1 versus expectations, driven a lot by weather and demand there, but also, industrial demand wasn't as bad in Europe as expected. And so things are actually outperforming. I think it's not only the big, beautiful bill in the US, we had big changes in Europe led by Germany in terms of a spending package that was completely forgotten because of the Liberation Day announcement that came immediately afterwards on April 2nd. And this is where, we are concerned that industrial gas demand, in terms of natural gas demand in Europe, is down. But when we look at oil demand, things look quite strong on that side of things. Now, the expectation is that we've front-loaded all of this demand first half of the year, and that it's going to fall off a cliff in the second half of the year. I mean, we've been hearing that China's falling off a cliff for 3 years. It's clearly not falling off a cliff. It's actually doing quite well. And, they're 4.5% to 5.5% GDP. We see that as entirely growth this year as entirely possible.
Maybe we all have to change our narrative to an OECD average and say, oh my God, China as an OECD mid-level economic country is totally outperforming all other OECD countries at 5%, rather than we're all still locked in the narrative of, oh, China used to grow by 10% and now it's less than 5%, so that's terrible.
And I also want to challenge a little bit on these Chinese inventories. I mean, China has a lot of inventories in SPR, so who cares? They're trying to build out something much bigger than Cushing. And they're not only doing it in the oil side, they're doing it, in iron ore. They're doing it across the board. And when we see how they've prepared themselves, building out all the renewable side, they're building out their grid. Their grid is 15 to 20 years old. Our grid in Europe's 45 to 50 years old. So we're in the much more necessary part of needing batteries, of needing natural gas, and needing oil refineries to keep running during heat waves, because we don't have that system on the electricity side. So we don't find it a concern in China. But of course, they build out so much renewables that they'd build out the grid more, which is more demand. It's not just about housing. It is more demand on building things out, and commodity demand, which we find to be supportive on oil. Having said that, if the trade deals all fall apart, I could, my balances can range between a 1.5 million barrel per day build, come September, to 3 million barrel per day. And we're in low inventories. We're very low inventories, I would say, on the crude side in the US, especially if you include the SPR. We're in drastically low inventories on distillate. I mean, we're well below the 5-year range, and that's if I use the tight 5-year range of 2015 to 2019. We're off that chart. So there is this immediate demand, and gasoline demand with these lower oil prices in the US will probably be at least 1% higher year on year. So we do see that, but
And
there
despite
is
all
this
of that, as you said
uncertainty
earlier,
and risk. So if companies don't know what to do in the Q4 and next year, then we better have a lot of interest rate cuts to help prop things up.
Sure. Well, I think that for many reasons they may be coming just because Trump is going to only hire the person who delivers them. Choi, on that point, I mean, it's not irrelevant to cut the interest rates. We're already seeing the dollar fall dramatically through the second quarter, down over 10%, now trading at about 118 on the euro. That, of course, weak dollar on the face of it is pretty bad for oil producers like Algeria, like the Gulf states, all their incomes in dollars, currencies pegged to the dollar. From your perspective, what impact do you think this could have, is having on oil producers' policy making, given the weak dollar and the weak income that is coming with that for them?
Yeah, I think this is why we should, if we want to unwind more barrels to the market, we should do that cautiously, because the risk, if I have to say all the time that if oil barrels prices go below $60, that what will these numbers do? OPEC members will do. I don't think they are going to cut more oil from the market. So when the value, when the dollar drops, I think compared to the euro, this is very good for the importers, for China, and even for the United States. And we see China has like record levels of stockpile of oil. And we have to look at what the declarations of Trump last week, when he said that he put like he's like easing the way sanctions on Iran, and he said he allowed it to let's say to export more oil. And that 1.8 million barrels of oil, of Iranian oil, is imported by China. I think this is what's really happening at the moment. So dollar, I think, is impacting most of the OPEC countries. If it's going low, I think it's really impact the revenue of these countries, and that's why need to control and to keep an open eye on what's really happening in the market. And especially now we are going on autumn, and we know demand may drop, and I think we need to control of that. So if we talk about oil price, I think, Sean, we have to talk about what's really happening in the US. So the last week we have seen that drilling rigs dropped by 7 in the United States. And I think this is an indication that, talking about the market share, OPEC is trying to recover. I think there is big pressure now in the non-OPEC producers, but we have to look also to Latin America. Brazil, for example, now has increased its oil production by 11% this year, last May, based on the last report. So then 11%. Now Brazil has like 3.68 million barrels per day. Guyana also is increasing a little bit its production, but I strongly believe what the OPEC Plus is doing at the moment is putting pressure on all of those non-OPEC producers, and it's really limiting their share. But I have to say, all the time.
I wanted just to bring Ahmed in on that. And Ahmed, we're certainly seeing in the US and the impact, and maybe further in Latin America, downward with the lower oil price range, downward pressure on capex investment. But I wanted, Ahmed, to get your views on how that is and could impact the Gulf states and the Middle East producers, because of course they've been adding capacity significantly in recent years. But now with this lower oil income range and with the weaker dollar, we're starting to see that maybe there's some cutbacks going on in Saudi and the UAE and elsewhere. So I'm wondering, from your perspective, how this lower price range, weaker dollar, could impact capex in the NOCs in the Gulf.
I haven't seen any evidence of that happening. I think if you look at the build out of ADNOC Drilling, the services industry in the region is actually doing quite well based upon their valuations, and also the way that NOCs are rethinking corporate strategies, bringing in private equity money. The cost of capital in the region is quite low. So even in more challenging countries like Iraq, you've still got contract activity up year on year. I think that certainly with the developments with Upper Zakum and the UAE, for example, the field development plans they're still ongoing and progressing. So I think you have to kind of separate what the current price range is based upon what between, say, the US and also type of oil field development, whether it's onshore conventional or even deep water. Break-even costs are actually low. So we shouldn't underestimate that, since in the last decade actually break-even costs have come down because of capex efficiencies.
Everywhere.
Yeah, exactly. So we have a more efficient supply side, or the cost curve is a bit more, the marginal cost of supply is also different today than what it was in, say, 2015, 2016. So when people talk about, oil running out, or the idea that, we need higher incentive prices, I think, that it's important to think about technology, even in the US, so I think where prices are doesn't signal necessarily, in my view, a big cut to capex commitments, particularly in the Middle East.
Let's go to the survey question of the morning. Again, it's sort of where we started. Will Trump's budget bill be bullish, bearish for oil prices, or neutral? No impact. The idea that it is obviously very much in the final stages, it would appear, but stumbling along. But at the moment, I mean, it seems that there is some resistance. Has been some. The Senate got to a 50-50 vote, and then got passed by the vice president as the extra vote, and now back to the House. So it does seem to be struggling, but ultimately you would expect it to get through. Bull, bear, or neutral? The seems to me, I don't know, I'm kind of in the camp that the US sovereign narrative, when it comes to debt and all of the dollar weakness and the stress we saw in the bond markets early in April on Liberation Day, that this is sort of, in the big picture of things, a weak, bearish for America. Nadia, just looking out to the second half of the year, and we choose some of these things as we struggle with them all, and to get clarity on them all. The first half of the year was incredibly chaotic, but we still had a $70 average Brent price. What do you think is the main North Star now going into the second half of the things that we've referenced today? The big, beautiful bill, the OPEC plus policy, the trade wars, the tariff, not trade wars, but tariff negotiations. Which of those do you think will you be watching closest for their impact on oil markets?
Number one, I would say, I'll do an order. Number one will be trade war, because this has been the big driver of uncertainty. I mean, when we look at the shipping market and behavior there, it's quite clear that investors have also been shorting oil and shipping because of concerns about this trade war. So that's just, on the speculative side, which then drives algorithmic trading. And then we have the overall S&D effect, which tends to be lagged. On the second point, OPEC matters, and I really think it is important that they keep the group together, because when you asked who has additional capacity to produce, we see Russia's sitting on 400 to 500,000 barrels per day of spare capacity. Are they going to stay in the group? It has been very important to the Middle Eastern producers that they remain in that group, because when we have a huge oversupply, like in COVID, that Russia-Saudi relationship is critical, or there are no cuts. So this is where I really agree with Ahmed that they need to have this in line. And then when we think about the US and shale and what we've said on this drilling aspect of things, if we have a price downturn, how low does it need to go? We've had a lot of producer hedging, especially in the shale patch, we believe, for the end of this year through next year, so they're more protected. But the part of the industry that may be the weakest link is the service industry, because as Ahmed has been saying, they've been focusing on offshore drilling. We're at 2021 level rig counts in the US. Yes, we have efficiency gains with 4-mile lateral wells run by Exxon, but not everyone can do that. So if we have this downturn, and we have what we had in 2015, 2016, where the service companies do not maintain equipment, and then we try to ramp up shale, we may be unable to do it. And so we go this lower spot, and then we go much higher afterwards. So those are the things we're watching.
Shoaib, I wanted to get your thoughts on a similar question, but also its relevance and impact for North Africa, for Algeria. Are you exposed to a tariff burden, a trade war coming, or your thoughts on that question?
Yeah, that Trump, I think, is targeting everyone in this planet. So there's no North Africa, Europe, US, Latin America, everywhere. So I think that yes, tariffs will impact any country, and especially I know countries exporting goods to the United States. But I think that talking about Algeria is excluded from because the tariffs and the U.S. tariffs are excluding oil imports, and I think Algeria, the main goods Algeria is purchasing to the U.S. and dealing with the U.S. is about oil, and I think it's really excluded. And this is a very good point. So talking about these tariffs, I think we have to highlight that amid these tariffs, many major American majors, let's say ExxonMobil, Chevron, and Oxy, are in advanced negotiations with Algerian governments to explore and exploit more oil fields in Algeria. And we know that the pressure shale drillers in the US are facing at the moment. As Nadia said, ExxonMobil has access to technology. This big major has really deepened effort to reduce the cost of production, but it's not the case for many firms. So that's why I think these countries are targeting Algeria at the moment. At the end of the day, they extract oil and gas from Algeria and just let's say trade it to the very close market, which is the European market, which needs more oil and more natural gas. And we know what's really the Europeans are facing at the moment, especially in kind of natural gas, as they are, let's say, weaning themselves off the Russian natural gas. So Algeria, I think, and North Africa.
They've set a target of 2027 for 100% off of Russian gas, which seems very ambitious. Let's wrap up with Ahmed. Ahmed, I wanted to take advantage of your expertise today to get some insight on the breaking story that Glencore is in talks with the UK government over the insolvent Lindsey oil refinery. What are your insights there?
Yeah, so it's very interesting. I mean, I think the takeaway from that is just about a broader development this year. The last 2 years we've seen quite a few refining capacity additions. The Middle East, making its pivot. With all that east of Suez capacity additions, but this year has been a sort of you've seen every month more refinery closures, in the Atlantic, and this is just one of them. But so far, you've seen about some high-profile ones, the Grangemouth in Scotland, in Los Angeles. So in total, maybe 800 KBD coming off, and then this raises a
permanently
big issue.
Or in maintenance.
Permanently closures, but about 800 so far this year in capacity closed this year. So this basically makes you think, well, okay, it's an interesting debate in the oil market about refining margins maybe being stronger for longer, particularly if perhaps oil demand in the Atlantic shrinks more slowly than refining capacity. At the same time, obviously, we have in China some. This month, PetroChina's, the first state-owned shuttering of a very big refinery there, Dalian refinery. So we're in a position where actually the Middle East Atlantic, movement of middle distillates becomes even more important. So it does raise a very interesting question about refining capacity closures versus demand, and our view of margins, longer term.
Well, we'll have to wrap it up there with Brent crude oil. There's the survey result, a good spread, bullish at 36%, 40 bearish wins at the moment. We're seeing oil prices are trading down, as we said at the beginning of our half hour, down about 0.75%. Brent at 68.62, and WTI about $2 back. We'll sort of watch that as we go into the weekend with this big OPEC plus decision, with the big beautiful bill, with the big tariff negotiations. A lot to focus on there. Will there be any shocks or surprises within those? Will OPEC plus not increase as much? Will the big beautiful bill not stumble more significantly than expected? Will the tariffs once again become an explosive event for the bonds markets? A lot could happen in the next week. Nadia, Martin, Wigan, thank you so much for participating today and this season as we come to the end of our season next week. I just want to thank you guys for your participation. Shuaib Boutamin, great to have you. And of course, Ahmed Mehdi, nobody better on
Thank
the
you.
granular end of refining Iraq and also many other things. Thank you all for your engagement this season. Have a great summer. Maybe see you in Vienna at the OPEC seminar next week. All the best, and we'll catch up with everybody tomorrow, Friday, 10:30 UAE time, and hopefully no gremlins in the sound. All the best. Thank
Thank
you.
you. Bye-bye.
Bye-bye.
You.
Bye.
Thank
Cheers,
you.
guys.